Welcome to Talk Tickers. Today, we're digging into the Q2 earnings for Pros Holdings. And let me tell you, this was a quarter that, well, it was full of contradictions. So, on the surface, the numbers looked absolutely stellar. Pros came out with a massive earnings beat. We're talking non-GAAP earnings per share of 13 cents. I mean, that's more than double the 6 cents analysts were looking for. A huge beat. And it wasn't just on earnings. They also beat on the top line. Revenue came in at $88.7 million, which was over $1 million higher than what the street expected. That's a solid 8% growth year over year. But here's where things get interesting. Despite the strong results, despite management actually raising their full-year guidance, the market's reaction was, well, swift and pretty negative. The stock got hammered, dropping from over $15.50 down to below $15 in the very next session. Okay, so this is the puzzle, right? A beat and a raise. So what on earth went wrong? To really get to the bottom of this, we've got to look at two things: the story management is trying to sell and what the market is actually hearing. All right, first up, let's break down that beat and raise. We'll start with the bull case, just looking at the numbers management put on the board. And honestly, by all accounts, the quarter was really, really strong. Yeah, the performance was impressive pretty much everywhere you look. Subscription revenue, which is, the lifeblood of a software business, grew a healthy 12% year over year. But for me, the real story is on the bottom line. Just look at that adjusted EBITDA, up a whopping 42%. Now that shows some serious operating leverage. It proves management isn't just chasing growth at any cost. They're focused on profitable growth. So let's talk about management's AI-powered story. On the call, the new CEO, Jeff Cotten, he didn't just sit back and talk about the great quarter. No, he laid out a really clear AI-focused strategy to build on this momentum and really hit the accelerator. And his plan is pretty straightforward. It really boils down to 3 priorities. First, apply more rigor to the top of the sales funnel. Second, expand their market reach with strategic partnerships. And third, and this is the big one, go deeper and wider on what they're calling agentic AI.
Okay, and this is where it gets really interesting. Listen to how they're framing their new Pros AI agents. The CEO made it super clear. These are not just conversational chatbots. He said they are designed to act as the most experienced members of your team. They're positioning them as these expert systems that can actually do things, executing complex commercial tasks by combining language models with all the data they've collected over the decades.
And a huge piece of this new strategy is a big partnership with Commerce. What they're doing is taking their powerful enterprise-grade tools, the stuff that handles complex pricing and product configuration, and embedding them directly into a major e-commerce platform. It's like they're plugging their engine into a much bigger car. It's a classic distribution play, designed to get their product in front of way more customers, way faster. Okay, let's recap. We've got strong results, a guidance raise, a new CEO with a clear plan, and a really compelling AI story. So that brings us right back to the post-earnings sell-off. How do we reconcile the narrative with what the stock actually did? Well, the day after the call, the stock tanked over 5%. I mean, that's a pretty clear rejection of the narrative, at least in the short term.
And get this wasn't just on some light, sleepy trading day. The move came on heavy volume, hitting a multi-week high of nearly 2 million shares. That tells you it wasn't just a few nervous retail folks selling. No, that smells like real institutional selling pressure.
So why the skepticism? What is the market so worried about? Well, as it often happens, if you want to find out what Wall Street is really thinking, you listen to the Q&A session with the analysts. And that's where we got some big clues. When you listen to the questions the analysts were asking, a really clear theme pops up. They basically ignored the great quarter that just happened and started drilling down on the future. They were asking, okay, what's the timeline? How long until all these changes actually lead to new bookings? They were asking about execution. Can these new partnerships really accelerate growth into 2026? They were worried about the macro headwinds, asking how the tough sales environment is affecting deal cycles. And crucially, they asked about monetization. How are you actually going to price these new AI agents to get people to buy them? And that right there, that's the core conflict in a nutshell. You have management painting this beautiful picture of a long-term strategic vision, all powered by AI and new partnerships. But the market is looking at the here and now, and it's full of questions. It's signaling some pretty serious skepticism about whether that growth reacceleration is really durable or even achievable anytime soon. So let's put it all together. What we have is a really solid quarter that's getting completely overshadowed by questions about future execution. And that brings us to the next call, our official verdict on Pros Holdings. All right, here it is. We are initiating with a market perform rating. The story here is definitely intriguing, but you just can't ignore the fact that the risks are very real and tangible. It really comes down to this balance between catalysts and risks. On the bull side, you've got some clear catalysts. If these AI agents really prove the return on investment and that commerce partnership starts to scale the pipeline, this stock could definitely move higher. But on the bear side, the risks are just as clear. If bookings stall, if macro noise keeps delaying deals, or if they fumble the execution on these changes, that's going to put a lot of pressure on the stock. For now, after that sell-off, it feels like the market has priced in this tension pretty fairly. So looking ahead, what should you be watching for next quarter? I've got 3 key things on my checklist that'll tell us whether the bulls or the bears are winning this fight. Number 1, subscription ARR growth. Can they maintain that 11% growth they guided for? That'll show the core business is stable. Number 2, early AI pilot results. We need to hear something from the first AI agent customers. Any kind of feedback, qualitative or quantitative, that would be huge. And number 3, free cash flow generation. Are they making progress towards that new higher target? That's the ultimate proof that the new CEO's discipline is actually working. This is not financial advice.